Yes. Hi, everyone. Welcome. And welcome everyone to Fireside Chat, Unlocking M&A Success, Fireside Chat on Insights, Trends, and Strategies. Next slide. Yep. It's with gratitude and respect we acknowledge that the lands on which Foresight operates are the traditional, ancestral, and unceded territories of First Nations, Inuit, and Métis people. And for myself, I'm speaking to you from Calgary, which is within the Treaty 7 territory. These are the traditional lands of the Blackfoot Confederacy, the Siksika, Kenai, and Piikani First Nations, the Tsuut'ina First Nation, and Stoney Nakoda First Nation. Before we start, I want to say a few words about Foresight. Foresight is Canada's clean tech accelerator, and our goal is to make Canada the first G7 country to reach net zero. We work tirelessly to position Canada as a global leader in clean technology. We bring together clean tech innovators, industry partners, investors, government, and academia to address today's most urgent climate issues and support a global transition to a green economy. Before we begin, here are a few housekeeping notes. Please use the Q&A option to post your questions to the panel. The session will be recorded, but the Q&A portion will not be. So it's my pleasure to introduce our panelists today. Sid Nair, Senior VP with Ernst & Young, Devin McMurray, Vice President with Ernst & Young, and James Shapira from Foresight, who will be moderating this session. Let's start with James, who will introduce himself and the panel.
Thanks, Isha, and welcome everybody. My background is I've been involved in financing companies for my entire career, and we wanted to bring together some experts on M&A because of the implications how it does for all companies. And where we're going with that is this is actually a rather unique subject because some topics will potentially affect more companies one way or the other. But in this case, M&A affects probably everyone. And how do we look at that? It's so one, you have an opportunity to utilize M&A for your own growth strategies. And you will get a lot of advisors will tell you you should not be doing M&A. That's likely because these M&A transactions can go bad. On the other side, they can actually shift your growth dramatically, and you could become a solution provider as opposed to potentially just a product or a widget supplier. So the M&A can actually really help you on your growth. It also is likely the way that most of you will find the path to your liquidity events. So looking at M&A and understanding how it's done, what you need to do, what you need to consider is absolutely critical to all of you. And what we want to do is bring in Sid and Devin to talk to you about how do you do it? What should you be looking for? What are the pitfalls? What's actually happening today? So let's give an update in M&A today because it actually is very active. As there is a shortage of capital is constrained. Companies are looking at M&A. So with that start, I want to turn this over to Devin and Sid to let them have a chance to give you their backgrounds, and then we'll get into the material and meat of the matter. Sid.
Great. Thanks, James. Good afternoon, good morning, everyone. My name's Sid Nair. I'm a senior vice president and partner in our M&A group. In EY's M&A group, I lead our technology M&A or investment banking business nationally. What that means is we work with founder-led, founder-owned businesses across software, tech-enabled services, other sectors, other subsectors like clean tech, as they look to prioritize their growth through either M&A or capital raising activities. I've been with EY for the last 17 years doing exactly this, which is technology investment banking across a number of geographies across Asia, the US and Canada. In my role as the M&A leader for EY, I also look at working with ecosystems across the country and startups and scale-ups in those ecosystems as they look for options to drive growth, either through strategic partnerships or by enabling them to have the right conversations with the right stakeholders across their ecosystems. So I'm happy to be here and happy to be part of this conversation.
Thanks, Devin.
Thanks, James. Hi, everyone. My name is Devin McMurray. I'm a vice president at the technology M&A team at EY. So, excuse me, I've been doing technology M&A for about 7 years now, exclusively working with private mid-market companies. One of the main areas that I spend my time on is specifically in the sustainability or climate tech sector. Here in Canada, we actually serve for technology kind of as our global center of excellence for those types of mandates. So, you know, this audience in particular is fantastic, and the partnership with Foresight the same. So, really looking forward to the discussion today, and with that, we can start to jump in.
Sure, let's get into this. Okay, so there seems to be a real conundrum with respect to the types of economic data that you're seeing. So we know that there's been constraints on capital. We know that there's been contractions on valuations. So we see some negative things. We've also seen corporate venture capital coming back in now in likely a lot larger way because the valuations have come into play. There's still dry powder. There's capital available. You have better and worse capitalized companies. How do you make sense of all of this? Where are we in the cycle? What is going? How is this impacting M&A? And like, are we in a downturn, or where are we? What should the companies be looking at as far as is there opportunity today?
Yeah, so I can take that, James. Thanks for that question, Devin. Maybe if you can move to the next slide, which talks about some of the market conditions. So you're right. We've seen technology M&A deal making being slower in 23 as compared to the last couple of years. However, the activity still is at substantial levels, pre-pandemic levels, and the way I would characterize the market is that for well-positioned companies that have focus on the right internal metrics around retention, whether it's growth, whether it's balanced growth with profitability, there is still capital to be deployed. VCs, the venture capital ecosystem has raised close to $400 billion in between 2021 and 2022. Most of that has not been deployed because we had the downturn right after. So that capital still needs to be deployed. However, capital providers are getting more discerning. They are getting discerning in terms of looking at the right metrics, looking at metrics that in some sense allude to efficiencies and growth driven by efficiencies within their within businesses to make those decisions. And what that means is a couple of things. One, I think equity is getting selective. So we are seeing equity getting deployed at seed stage. There are acquisitions happening, but in growth stages of equity financing, equity is getting selective. So unless you have the right metrics to show for and a clear path on how to deploy that capital and get to a capital efficient, profitable model, venture capitalists are becoming extremely cautious on deal making. So what does it mean from a deal making standpoint? For the right companies, there is still enough capital around, whether it's on the acquisition side or on the growth financing side. Have we seen multiples drop? I would say for the right companies, multiples have stayed pretty strong. Devin and I recently worked on a couple of ESG transactions, which are in the clean tech space, where we had fantastic outcomes for founder-led businesses. Spaces like those have continued to trade at strong multiples. So I would say for the right assets, the market continues to be active. However, on the downside, what we have seen is that deal making is not as easy as it used to be 12 or 18 months ago. It is taking longer processes, so longer in terms of time, more diligence. So people and buyers and capital providers asking a lot more questions. They are looking to mitigate risk as much as possible. And as I said, there is more of an emphasis on the path to profitable growth and capital efficiency. So from that perspective, I think companies that are well positioned are still attractive to investors and acquirers.
It's actually interesting. So, like when you get into the clean tech space in particular, it seems to have been holding up relatively well, both in investment dollars being placed out and the valuations. Um, in Do you know what are your thoughts with respect to what's driving that? Like, are LPs required to have positions in clean tech, or is it there's just a space that they're really thinking that there's still room to grow, or what's and what's your thoughts on what's causing this? And it seems to be a little bit of a differentiation between some other sectors. Like if you're in healthcare tech, you're probably hurting a bit more because of the times. To what Sid was saying about profitability.
I think that, yeah, it's a great kind of prompt, James, in clean tech in particular, and we did want to spend a minute because it is probably different than like the broad scope. So it's worth a closer examination. And even at that kind of high level, if you look at deal and fundraising count, volume and dollars, at first glance, if you didn't see the slide before, you might say, okay, well, things are looking a little bit depressed in 2023, but the fact that there is kind of meaningful levels beyond 2019 and 2020, we all know 2021 and 2022 were kind of boom times in the market, does really at the highest levels show that this space has been more resilient from investment. I think why the answer is probably different for different aspects of clean tech. I think that they're, at the venture level, there are certainly new and innovative technologies where venture is seeing that type of kind of venture model that they like, the venture scale opportunities and market demand. I also think a lot of it has been regulatory driven. Particularly we've done a lot of work on the climate risk compliance and strategy side, and certainly there's massive tailwinds there that's driving a lot of that activity, and I'll probably get into that in just a second when we talk about kind of specifically what we've seen in some of our deals in this space. And so yeah, I think high level volumes relative to other kind of tech areas or sectors has been quite strong. In terms of key trending areas, as mentioned, it's kind of like what are the innovative technologies that are solving kind of the next set of problems or most material problems are around clean tech and climate tech, and then there's the compliance driven items too. I think on the software side, where we spend a lot of our time, certainly a lot of momentum there. And talking about the software side, I think there's a great set of case studies that we can bring to bear. So as we mentioned before, we do mid-market M&A across basically all types of technology companies. One of those areas is software, and in the kind of climate tech area, there have been 3 companies, all with meaningful Canadian operations, all of which are in the kind of some version of the ESG or sustainability reporting and compliance space, all transacting in the last 18 months. We advised on all of those transactions. And I think, the one on the far right metro happened in June 2022. So just as, some of the market trends we're seeing are now taking place, if you look at Ecometrica and FigBytes, these transactions closed in the last 6 months. So it really also not only is a lens in the space, but how it's developed over time too. So we'll talk about these companies a little bit today. I think the key learnings at the highest level is that, and Sid already mentioned this, but from a valuation standpoint, there's a significant amount of resilience around these types of companies, and I think a lot of it is driven that there's a lot of dollars chasing after these companies. It's also as everyone here would know, highly specialized technology. So it's not replicable, and that's why you see strategics or corporate venture arms trying to chase that through an acquisition type strategy or through an investment type strategy in particular. One of the other key learnings we've seen is in terms of being able to get the right talent. There's certainly been some positive tailwinds for companies in the space getting more momentum and more top talent wanting to move to companies like theirs because they want to make a difference in terms and then they want to work for an impact company. And therefore, these companies have been, especially in the startup phase, been able to leverage that to getting some really, really top technology talent into their organization. One of the other very interesting things is the broad universe of strategics and financial investors looking to get that exposure into their portfolio. So it's not just on the financial investor side, but we're seeing all the companies and really any possible adjacency you can think of trying to figure out how can we get exposure to this market trend? How can we also tie that to our own corporate goals and vision and mission? And therefore, when we take clean tech companies to market, we're always casting a little bit of a wider net than we normally would. We typically take a targeted approach to our processes, but we are finding that, a media company, for example, that you might not think would be interested at all has a specific angle or something being talked about at the board level, which makes it relevant, which is kind of keeping that really open mind about the space and makes it an interesting one for that reason. And then I think the last thing we're seeing is that earlier stage companies with differentiated IP are certainly attracting investors and acquirers pretty early in the scale of the company. So we are seeing companies transact earlier than they might have initially thought or get investment than they might have thought, because we're seeing acquirers and investors who are actually explicitly saying to us, we're willing to take away our normal criteria because of the importance of this space and the level of technology that's in innovation that's taking place here, and taking more IP-led decisions than their maybe typical corporate playbook, for example.
Okay, that's really interesting. So what we're seeing is there has been a change macro market position. It is actually causing the corporates that couldn't necessarily play in an overheated market to now be back in that marketplace where they're now looking at it as far as opportunities go. But so given the current market, how are you seeing companies how are they thinking about this? Obviously you can be a little bit more creative with respect to what your next steps are, and then with respect to how being creative, you don't want to necessarily be selling out in a market today where maybe you're not getting the valuation that you want, but there could be ways to structure those deals to actually make it work over a longer term. So what do you have to really consider when you're looking at the alignment of what you're trying to achieve? Because this could be, to your point, it's access to both financial and intellectual capital, because if you're partnering, you're getting potentially actually those both things taking place. But how do you actually help the companies work through that when they have those opportunities, this can actually be a real game changer for them? So thoughts with respect to being creative, what do they have to think about? How do you move forward in this type of environment?
Yeah,
for
that's
their alignment,
Yeah, that's a very interesting question, James. And oftentimes, when we are called in, the question that we ask founders or the shareholder group is, how would you define success for the founder and for the shareholders and the company? And there are different elements that are probably more priority for certain shareholders versus the others, and oftentimes valuation is the overwhelming favorite in terms of what people are focused on. But when we define a successful transaction, there are other things that are important to other stakeholders in the business. So when I talk about stakeholders, this is not only shareholders of the business, it is customers, it is employees, it is partners, so on and so forth. So Some of the things that we ask people or ask stakeholders about, other than valuation, when they define success, is what are you looking for in the right partner or right investor? What does the right partner or investor do for you? Do they give you more sales and distribution capabilities? Are you looking to accelerate your product roadmap? Are you just looking to enhance the ability for you to attract more talent, because talent in some niche specialized areas are in short supply? So what are you looking in the investor or partner that would make them a preferred partner? The other thing that we often come across is when people look to, or when companies look to raise their first or second round of capital, they are still not sure whether they want a strategic or a financial partner, and what the nature of that strategic or financial partner would look like. So oftentimes they ask us to maintain optionality through the process and through deal mechanics, right? So if it's a strategic partner, can they come in minority and then have an ability to buy the business later through certain predefined parameters? From a process standpoint, optionality means that you run a dual track process, reach out to financial investors and strategic investors, and depending on terms and what it means for growth of the business, you decide on one that makes the most sense from long-term objective alignment standpoint. And probably the last thing that I would touch upon here is most people do focus on numbers and financial terms, but it is also important in my mind to optimize non-financial terms and conditions. So for a founder, that might come in the form of non-compete, non-solicit obligations. For employees, it might come in the form of, options for them, or what it means from an equity participation standpoint. What does it mean from a continuation in the same role and driving the same kind of impact standpoint in the organization that is acquiring them? All of these are important conversations, and unless you have a very structured, thoughtful, and deliberate process around how you can balance these various shareholder objectives or stakeholder objectives, often what ends up happening is you have one stakeholder or a few stakeholders happier than the others. And therefore, when we sit down with customers, we do start with that first question, which is, can you define success for yourself and your key stakeholders? And then, that ultimately helps us drive a process that minimizes business disruption so that, we can effect the right kind of outcomes, run a very structured and efficient process so that we are going out to the right parties. We are having the right conversations. We are bringing in management only at the right times, and trying to, quarterback most of the conversations, giving them the time to focus on their business. And lastly, drive towards the achievement of your business plan, because as you can imagine, a financing or an M&A process is an often, takes a lot of bandwidth. So what we are always cognizant of in the context of a process, run a process once you define success in a way that management has enough bandwidth to go achieve their growth ambitions, because the last thing you want during a process is you not meeting your numbers or not meeting your goals.
Right. There, to unpack everything you said there would take a lot of time, but I love the way you started this, is how would you define success? Because otherwise what you're just focused on is a transaction for the sake of a transaction, as opposed to a transaction being there to fill a very specific objective of what you're looking to do. So this is way more strategic and tactical than you think about it. Now, one of the things I wouldn't mind Devin talking about is, and this is a really tough area to get into, is because this isn't about necessarily an M&A deal where you actually sell the entire company. What you could have is mergers of equals, because you could actually do means of actually putting two companies together where each are bringing an element of this, and as opposed to recreating the wheel, you can actually utilize this tool to move the company forward. Now, obviously, that's tends to be easier said, and why the advisors will tell you don't do this. But it's with expert advice and helping to guide through those processes that are key. Now, one of the things to look at is, how do you look at the value of these things, and how do you look at what it's going to be at the end? Because relative valuations, most people think, well, I can't do an M&A deal because I don't have the cash to do this. Well, it's not a cash deal. You're actually looking at potentially just exchange of shares too. So valuation becomes an element of these processes. Do you want to try and take that on and unpack just that sector of where you look at the valuation when you're doing these deals?
Yeah, for sure. And I think you touched on a couple good things there. And specifically, there's the how do you look at the sell side and how do you look at the buy side? And frankly, a lot of the same factors still come into play. And when we say sell side, selling your business, buy side, acquiring another one. And so, I think this is a topic that you could spend a huge amount of time on, but to try to put it in a bit of a box, like the way we often think about it is there's the business fundamentals, right? So this is kind of the underlying fundamentals of the business itself. Then you have the equity story, which is basically, how do I take those fundamentals and where the business is today, and how do I turn that into a concise and cohesive story that's going to translate to whoever I'm talking to, right? So if I'm talking to, whether it be an investor or to a strategic acquirer or a corporate venture, there's how does what you have underneath then translate into something that can tangibly connect with a story that party can connect with and deliver value for. So I think that's kind of an enhancing component. And then I think the last piece after that we'll get to in a second, which is around what kind of structure can you wrap around that. That's where people like ourselves often play a big role to kind of make sure that there's the right elements and ingredients and competitive tension, that this is done in a way that creates an optimal outcome. So on the first one, the business fundamentals, we have an example here, right? So this is specifically looking at software. This will look slightly different for every business, but I think broadly speaking, when we take a scorecard approach to valuing the fundamentals of a company, a technology company, we tend to look at it in four kind of rough quadrants, which are on the left-hand side. The growth and efficiency, the business model attractiveness, the size of the opportunity, and the product and technology. And what falls under each of those is going to be slightly different depending on what you're looking at. We have a set of metrics that we often use for software up here on the screen. And there isn't a perfect way to weight each of these. There are different elements, and in fact, the weightings change a lot over time. So I mean, a good example is under growth and efficiency. We came out of a period where that top metric, revenue growth, was so important. It was the first question we were getting asked when we were talking to investors and acquirers. I think there's been that pivot. I think everyone said, okay, well, to profitable growth. I would take it even a bit further, which is more capital efficient growth. So I think investors and acquirers are willing to underwrite investment dollars. In fact, that's often the role that they play, but they want to understand that the underlying unit economics and for some early stage technology, this might be down the road, but at some point, the underlying unit economics makes sense. The business model attractiveness, again, there was particularly in software, a real attraction, and there still is, to recurring revenue streams. But I think increasingly there's an openness to the roles that services play in that. So, these are all examples, but the point here being that, understanding your business fundamentals is, what space do I play? And then what are the kind of key metrics that are going to be driving that? And then how can I strategically look at this as a business? And frankly, depending on where you are in your life cycle as a company, the emphasis is going to change as well too. So we would tell someone very early stage, you want to focus on the product and technology and the size of the opportunity at the bottom of here. And you want a more proof of concept at the top of this, which is saying, when I get to scale, these are the reasons why, I believe that this will have an underlying business model attractiveness, why I think that, we will be able to command a large sticky contract. Or another great example is like, given the setup of our technology, when we reach a certain point, there's going to be immense network effects because we're selling into a company that is going to then disperse it around their network. So I think, early stage, think of the product and tech and size of opportunity, but be keeping in mind I need to kind of show the proof of concept that at scale, I'm going to be able to do some of these other things. As you get later stage, you then need to actually be showing how, when you get that product market validation, that's then showing up in the business model attractiveness and the growth and efficiency. And you might say, okay, well, there's a lot of numbers here. How does that kind of how do these metrics realistically translate to value? Which I know is part of the question. And this slide here, we took one of those metrics, so growth efficiency. And what growth efficiency is in the world of software is often called the rule of 40. But it can be translated to any business as some combination of how fast can you grow and how profitably you can do it. So the rule of 40, for those who know, would be if you take your revenue growth and your margin and you put those two numbers together, is it higher or lower than 40? And so what we tracked here, and this is using our own software deals, anonymized, of course, with the size of the bubble kind of representing, generally how large the transaction was, is we plotted that rule of 40 metric against a recurring revenue multiple that the business commanded. And you can see that the R squared is 0.6. It's very high as a single metric. It's actually, when we ran this analysis, the single metric on the software value scorecard that translates to value. But I think the point is that there is high correlation between these metrics. So grounding yourself in those kind of fundamentals and thinking about them in that way will allow you to be speaking the same language as investors or as acquirers.
I think that's absolutely so important that they look at it, because it's not just from the perspective of being able to raise capital. It's ultimately, and I'd like to get your thoughts on that for a second, because if you're designing your company, you're designing it for ultimately you want a liquidity event at some point. So acquirers are going to be looking at that. You got to design something for ultimate sale, or you're not going to be sold. Do you want to just maybe touch on it a little bit, because it's so related to that last point?
Yeah, I think that's right. Along the way, you have to be thinking about where your destination is, and I think that actually ties really nicely into this equity story point, which I'll get into a second. But it's what are the business fundamentals now, and which are the ones that can be proven today, whether it be through studies of the technology or pilots, and then which are the ones that you say, at this point in our maturity, we are going to start showing up in this metric this way. So I think often you're kind of thinking about where I am, but you do need to, and this is where advisors can be helpful, to be like, 5 years from now, what is the the person who's going to be looking to put capital in this business going to be looking for, not just the one for 1 year from now. And sometimes we see companies that go through multiple rounds of financial investors, and the ones that are really good are saying, so my first round of financial investor is going to want this, but my second round of financial investor is going to want that. So I need to, going back to Sid's point, I need to have an objective alignment with my first investor that this is where I am today. This is where I think I need to head with the business, from kind of where the kind of key metrics and fundamentals are to be successful.
Okay.
And that does really relate to that building the equity story and strategy around your business. And this doesn't have, these three situations are surrounding exits of the business or acquisitions of the business, but it doesn't have to be that way. It's really just how you are presenting yourself from a capital standpoint and the way you're positioning your business. And I think that what it boils down to is starting with where your core strengths are and being very realistic about that, figuring out which key KPIs drive that and which areas of scrutiny you're gonna go under to prove that. So it's one thing to say it, it's one thing to track KPIs around it, but it's another thing to actually be able to go under scrutiny for that. And when all of that is done and you've been tested on the strengths, what does that tell you about the story of your business? And when we say equity story, from an investor or capital standpoint, that's going to make it particularly attractive to the market. And again, that's about thinking of and developing that story today for the future. So, Big Bites, ESG reporting company, Canadian company, fantastic sales motion, awesome key reference clients given the scale of the business. And they did such a good job at clearly articulating their target customer and being hyper focused on having a solution that caters to their needs. They were an enterprise focused solution. So key KPIs they were thinking about was pipeline size and conversion. If we're going enterprise, we need to show that it's a strong sales motion. We need to be able to show growth, and we need to be able to show that when we get those customers, we keep them. So where were the areas of focus? Where are the areas that they need to be scrutinized on is how can you do that efficiently? How are you continuing to replenish pipeline and doing that in a way where that translates? You have a clear path to profitability or plan to translate that sales success into future cash flow, right? And so, the equity story that pops out of there is that this sales motion and the way it knows its customer becomes a really strong cross-sell piece in a suite of solutions, because it's, for what it is, it really knows who it caters to, and it really can work in a cross-sell type motion. And that's the type of buyer it found, one that has a great set of solutions that this could pop right into. When we think of Ecometrica, a mid-market kind of ESG and climate risk tool with just a really strong product and vision from the management team around that product, and very disciplined approach to how they grow the business. Their key KPIs were growth efficiency, the number of customers they were adding, and the number of channel partners they were adding to drive that customer success. The areas of focus for them is around that product offering they have today and how that roadmap future proofs them for the future, the go-to-market channels in which they can deliver that, and the time to value. So the way that they can kind of do that in rapid succession using their different go-to-markets. And so, their equity story is how they've got this platform that's plug and play, future ready, delivering quick time to value, and found a partner that, admired it for that. Metrio being the last one, again, playing in that kind of ESG engagement space and reporting space that is, had very clearly differentiated features in the market and were known for them, strong depth of expertise. So what they were thinking about was, how does that translate into revenue and customer growth, and how can we land and expand off of the back of our certain features that bring customers in? So their areas of focus was continued market momentum and differentiation with that market. And for that one, again, they found a partner who valued them specifically for that feature set that they had. So, they aligned very well with a single customer persona in particular at the time, and they found a buyer who very valued them for their ability to access that customer persona. So in each case different, but hopefully the examples and the case studies show you how that thought process can translate the strengths of a business into an equity story.
Okay. I'm going to shift gears a little bit, because obviously when you're looking at and I think this is going to actually help a little bit explain. So I think you might have anticipated my next question, because I'm looking at, when you think about this, most advisors will tell, especially early stage companies, to never do M&A. And I actually like to say, I actually will agree with them all the time. I will not argue with the point, because I actually don't agree with them, but I don't want them competing against me. I want to use this strategically. I want to use tactically M&A as a means of moving companies forward. Now, all companies do this. Doesn't matter your size, large, small. Smaller companies have some interesting advantages in that they won't have competition out there bidding on an M&A deal, like if they find this. Now, but the challenges across the board are the same. These are very time consuming. They're not easy transactions to do. You need, one of the reasons why I think most people say don't do this is because, for the most part, the teams don't actually understand how to do M&A. They don't understand how to use that tool. And so, instead of shifting the growth curve up, it does, but then it turns it really quickly down, and you don't understand. It's not about the marriage, it's not about the wedding, it's about the marriage. And so you can have the closing of the deal, but then it goes down. How do you actually look at this area and say, what's your experience have been with respect to earlier stage companies utilizing M&A? Should they be doing this? How do they use this to spur their growth or change their growth trajectory? Because if you do this right, you not only can shift it, but you can actually not just shift it up, but you can change the trajectory of your growth. Because I think that's something that, Devin, you were talking about. Sid, you want to touch on how to do this properly and how to engage with proper advice so that you can have a successful outcome when you do this.
Yeah, sure. So I would answer that bucket in three questions, right? First, it's important to have a clear thesis around why you are doing M&A. Like when you're doing M&A, you probably need to have the same mindset as large buyers in terms of making sure that you have a clear investment thesis on what this M&A does to your business, how it drives growth, how it serves your customers, and how you're going to execute on the M&A before close and after close. So there needs to be a clear investment thesis, because at the end of the day, whether it's big or small, in relative terms, you want the M&A to be successful. No M&A can be successful if you are not prepared in advance for what is going to come next in the evolution of doing the M&A. So that's the first bucket. The second bucket, I would say, is smaller companies, because they are nimble, because they don't have access to capital as some of the large strategic buyers would have the flexibility, because on the other side, they have an equally nimble small business. They have the flexibility of being creative around M&A. So in terms of deal value, deal structure, equity incentives, in terms of how employees can come together and all of that, so that 1 + 1 can make more than 2. They are more nimble just by the nature of where they are in the evolution of their business. So I think from that perspective, they are more at an advantage trying to do those kind of transactions, because it needs a different mindset, but it also needs different creative thinking and solutions to come up with a win-win solution for both parties. Okay, so that's the second bucket. I think the third bucket, and this is something that is often overlooked, whether you're doing a big transaction or a small transaction, is that transactions are all about people, right? At the end of the day, they are all about people. It is more so the case when a smaller company is trying to accelerate its ambitions by acquiring a company of its own size. I mean, a large strategic buyer, if it takes a misstep, doesn't really move the needle, right? But for a smaller company, it does. And some of that revolves around people and personality. And we often say in deal processes, the difference between a successful and not so successful outcome is people and egos. And you have to make sure that you put people front and center when you're doing acquisitions of that nature. Because unlike a large strategic, you don't have the ability to do it wrong. And therefore, it's important for you to have the right tenants at the core, so that you're driving an acquisition around those fundamental principles. And here, what you'll see on the slide is how we typically run an M&A process, right? And irrespective of what you see on the left side of the panel, which are the phases of the M&A process, I think the objectives that you see here on the right side, whether you are doing a smaller acquisition or a large strategic is trying to do a bigger acquisition or somewhere in between, those objectives are consistent, right? What you're trying to do is maximize value by bringing these two companies together. You're trying to minimize transaction risk. So you're trying to minimize risk from employees being disgruntled, customers being disgruntled, or any of that, and trying to keep management happy. You're trying to do it with the sense of maintaining momentum both for the process and for the business. You don't want the process itself to be overbearing for the businesses to continue chugging along at the right trajectory. Minimizing disruptions for management, because management needs to be laser focused on driving the business forward. Ensuring confidentiality, because smaller businesses are unduly impacted by word getting out that they are doing a transaction as compared to larger companies. So all of that is important. And lastly, preserving optionality. And when I say preserving optionality for a merger of equals, it means always have your thinking caps on so that you can come up with creative structures, because you probably in that situation are able to, there is more appetite to go do that.
I'm just going to jump in here because I think there was a question that came in from Henry, and it says in angel financing, much is said about the team's contribution to valuation and the types of deals we're speaking about today. Where does the team stand in terms of valuation? And it's a really important point, and should have been brought up in the scorecard. Like, team and people, as Sid said, is essential to all of this. I think that the way that it changes at more of the very early stage concept as the company begins to mature is it goes from, in the very early stage, the team itself and their background and expertise is underwriting or is lending credibility to much of the kind of assertions or proof of concept about the future. So when I was talking about the scorecard, how the lower half is kind of what you're doing today, and then the upper half, you start to prove it. I think, as the company scales and they have that team and some of those, proof of concept points begin to be validated, it becomes a lot more about, is this the team that is going to be able to bring, whether through an investor or an acquirer, the company into its next stage or where it's going? And do they have a clearly articulated vision about what that is? And the answer to that might sometimes be, and still get a very good valuation, like, we think we need these 6 pieces and we feel really good about these 4 from a team perspective, and these are the 2 that we'd be looking to leverage resources for, or we're in the market for, or we'll need to add once we get to this part in our growth. So I think it's a really active part of the conversation. I think, like, as the business grows out, it's more about where the organization needs to go and what are the competencies of the individuals to drive that. But really good and important question. And I think the only other thing before we get into the next slide here that I would just piggyback on about the point about acquiring businesses would just be bringing it back to today's market a little bit. Like, today's market where we are today is fairly conducive to that strategy, because I think more companies in this market that, whether you want to call it a market downturn or just a dynamic market, they're more open to options and flexibility. And I think what Sid mentioned in his second point, that kind of creativity element that is often needed to get, for smaller companies to get transactions done, it's just today's market is a lot more receptive to it overall. I think that, companies that were thinking that venture funding was going to be the long-term route for them are open to an earlier exit. So it can be a really effective strategy, I think, as Sid said, so long as it's, very synergistic. And I think you need to make sure that it's synergistic and intentional. But just wanted to add that, like, not only is it a good thing, but it's a good time to do that thing as well.
Okay, so ultimately, M&A can be a tool in your toolkit that enables you to execute on your plan. It is just one of those tools. You can obviously grow organically, or you can grow inorganically through the acquisition trick. But one of the things I'd be really interested in, and I think it's going to be super important here, because it's not easy, and why I know that people give advice to say don't do this is because so many things can go wrong in that process. You need to have proper advice. You need to have somebody that has had the experience and gone through this, because it will be all encompassing. You will not be doing anything else other than this. So you will get into a deal silo if you go down this path. But but this thing can be a great tool as a means, as you just said, for an ultimate exit. So, but you can't use M&A either in the course of your growth or ultimately for the end goal, and unless you're designing to what you guys have said. You have to be designing what is ultimately saleable at the end. So if you just do M&A and put together a whole bunch of companies that make absolutely no sense, that's not going to drive value. So what I'd be really interested in getting your thoughts on is, for those companies that you've been involved with that have utilized this tool, some of the best things to do is learn from where you really messed up. What are the things that parties had wished that they had not done, or maybe had looked at differently in this process? And I'd like both of you guys to really dig into this, because I think it'll probably be our final point on this. Let's not repeat mistakes that have made in the past. Let's make new ones, just not the ones obviously that you want to avoid. So let you guys decide who wants to go first on that.
Yeah, so I can go first, and then Devin, feel free to chime in. And I think one of the core outcomes of our value scorecard session is making sure that companies drive towards not doing the mistakes that we've seen other people doing, or learning from best practices across leading technology businesses. And I would say that there are a bunch of items on this checklist, but I would say I would highlight four. The first is, think about your customers, and think about the contracts that you have with your customers. Do you have customer contracts that are onerous to you in a change of control scenario, or a financing situation? Are there unique contract terms that you need to think about proactively before an exit process, because it will save you significant time in due diligence, because this is one of the things that almost all buyers get fussed about. The second thing I would say is, and this is very, very important to technology businesses, is the sanctity of your core IP, how it's protected, right? IP is developed by a number of people in technology organizations. There are some cases in which you use an outsourced provider to develop IP for your own business, just because you're trying to be nimble earlier on in the business. Make sure that your IP agreements are ironclad. Make sure that a lawyer has looked at your employment agreements or your outsourced party agreements to make sure that that IP that you develop is protected, belongs to you. The underlying data is secure and belongs to you at all times. The third thing that I would say, and this is important, to make sure that you show the sophistication and maturity of your business, despite being a smaller business or a scale up, or a business that is growing quickly. I would say third-party validation, timely third-party validation, periodic third-party validation is critical to demonstrating mature technology processes, mature reporting processes, and just the overall maturity of your product and technology stack. So what do I mean by third-party validation? Make sure that you are doing periodic code scans. You are doing some kind of technology due diligence where a third party, or you through a well-documented process document and framework, are documenting where you stand with specific attributes that are important to buyers. For example, vulnerability, scalability, extensibility, how robust is your code? Have you done third party code scans to make sure that there are no bugs and there are no red flags around your code? Make sure that a third party is validating how you're calculating your reporting metrics and where they line up with how buyers look at these metrics, whether it's metrics around churn, whether it's metrics around margins, all of that. And the last thing I would say is the 10 point that is highlighted here. Most processes that we are part of has an element of a party that pays strategic premium because they have rubbed shoulders with the company earlier on, either through a partnership or they know of this company through the competitive landscape, or they have done some portions of work with them. Make sure that early on in your evolution, you are brushing shoulders with key industry participants or potential partners, so that by the time you are thinking about a transaction, you reach out to them, you are well credentialized. That might be the difference between a credentialized party giving you a strategic premium versus you reaching out cold to somebody you think might be interested in your business. So those would be the 3-4 points I would highlight. Devin, feel free to chime in.
And just before Devin gets there, because so you actually said something that was absolutely critical, and I've seen this get messed up in deals. Looking at your contracts is absolutely critical because, for instance, I've seen ESOPs that are in place that an M&A deal could cause a change of control, and in that triggering, you could actually have payments that have to be made to employees who then may just leave. So if you structured some of your deals wrong at the beginning, you actually can't use this, or it may actually limit your ability to use it. So that it's not, your point on the contracts is absolutely critical. Devin, your last final thoughts, and we'll
Yeah, I know
up.
we're wrapping. I was just going to quickly, and I answered a question in the chat that I think Sid kind of tackled anyways.
Yeah.
But all I was going to say is, like, these seem like specific things, and you might be thinking, okay, but if there's customer consents, I can deal with them in the process, and that's all true. Most of the time, these are solvable things. The thing that they trip up is momentum, and in an M&A process, keeping momentum is so important to getting the outcome that you want. So the reason why we always stress doing these things in advance is because once you start that process and that discussion, having strong momentum through to the finish line is, in terms of just running the business, in terms of getting a good valuation, is super important. So that's why we always like to stress these points. Thanks, James.
Okay, thanks, Evan. And I want to thank both of you guys. And for our audience, M&A is absolutely a tool in your toolkit that you should not just ignore. But as you've seen in both Sid's and Devin's comments, having the right advice and engaging with you guys earlier on is probably going to be a lot better, so you're prepared for these transactions, whether it happens to be one that you're utilizing for growth or one that you're looking for at the exit. I'm going to turn this over to Astrid, who is going to take us to the end. Thank you so much. It's been a pleasure working with you guys. Super helpful. And I hope our audience can actually reach out to you for support as they engage on M&A deals.
Thanks,
Thank
James.
you.
And thanks, everyone.
Thank you so much, James. And thank you, Sid and Devin, for providing your expertise on the theme. Very, very appreciative of you and the EY team. Also for the audience, make sure to tune in for the next Fireside Chat. It's going to be hosted in January 16, and it's going to be around governance. I pasted the link here in the chat for everyone to register. And happy holidays, everyone. Thank you for joining us on such a great series, and looking forward to see you next year.